Hello everyone, John Rosengard with Environmental Risk Communications. Thanks for joining our webinar today on decision analysis and financial modeling for environmental obligations. Our outline for today is I'll give you a little bit of background on decision analysis tools and what we see as best practices in decision analysis, particularly as it applies to environmental liabilities, and best practices that we see in financial modeling. Again, as exclusively we see them applying to environmental liabilities. I'll be recording today's session for publication later on YouTube, so I ask if you have any questions, please delay those to the end. If you'd like a copy of today's presentation, please open the GoToWebinar control panel, take a look at the handout section, and you'll notice a copy of today's PDF presentation available and waiting there for you to download. By way of background for me, I'm the founder and CEO of a company called Environmental Risk Communications here in Oakland. I started the company in 1994, so we just passed our 22nd anniversary. I'm the author of a software tool called Defender, which helps with environmental liability forecasting. That's all that we do. Our software is used for looking at remediation liabilities, asset retirement obligations, and for those of you that work in the public sector, what are called pollution remediation obligations. These are all accounting terms, and they're all really different looks at different types of environmental liabilities. Our work is also used in due diligence and in watch list generation of future reserve increases, as well as our work on doing decision analysis on specific sites. We've also done counterparty risk tracking for more than 15 years now, looking at the composite credit scores of individuals and entire PRP groups to figure out the ability to pay of not only single companies, but also the whole group. So who do we support? Our work, it goes in support of corporate remediation teams in general, but also PRP groups periodically, as well as the port authorities that exist here in the U.S. as public agencies. We also support the engineering, consulting, and legal partners that back them up as the duty holders. And we also support internal and external auditors that are making sure that environmental liabilities are accounting for properly. My educational background is more fully explained in my LinkedIn profile. I encourage you to take a look at that document and see some publications that I've issued if you're interested in more detail. But by way of educational background, I've got an MBA from Northwestern in Chicago, a bachelor's in business from Georgetown in Washington, D.C. So I've got 2 business degrees. I'm not an attorney, not a CPA, not an environmental engineer, chemical engineer, civil engineer. I come at environmental liabilities from the perspective of a software developer and as a management consultant who helps, again, generate liability forecasts that make sense. Our toolbox that I'll be covering today is really a high-level view of all the tools that are available out there and applicable to good capital stewardship. But I'll be covering just the 6 that are listed here because I find that time and again, these are the ones that work and apply to environmental liabilities. ASTM, the American Society for Testing and Materials, has a good standard out called E2137 for estimating the monetary costs of environmental matters. E2137 came out in 2002, so the graphics are being updated as we speak in 2016 with a new version of the standard. But this version, this decision tree that's in place, still shows the textbook method that's used for calculating an expected value. This is the definitive method that's been around for more than 75 years, just applied to environmental liabilities. What you'll see here in this example is that there's an uncertainty around whether contamination in the soil is deeper or shallower, and that's a break point for this decision tree. And then there's a decision in turn whether to pursue generic cleanup goals, that's what CUG stands for, generic cleanup goals or looser risk-based cleanup goals at a specific site, and then in turn drives the volume of contaminated soil that we're looking at and trying to evaluate. The next breakdown in the decision tree, moving left to right, is whether to send the soil to a landfill at a higher cost or soil vent the contamination on-site at a lower cost. And from there, the calculations are done. The outcome is costed out by the probability of the individual outcome, which is, again, a subjective judgment. There's a lot of professional judgment in using decision trees, but the calculations are just as you see here. You multiply the outcome cost times the outcome probability and generate a contribution to expected value. That's the basis of the E2137 decision tree, a fairly normal, ordinary use of a different way of calculating an expected value for an environmental liability. The following graphic on the next slide is the next generation that we put into the 2016 edits. I take full accountability. I was on both committees in 2002 and 2016. But this is the newer version of an event tree that we're incorporating into E2137. And you see here, moving left to right, we have a differentiation between what is the media, so that there's a clear selection of what type of problem we're looking at. Next, we look at uncertainty, and these can be in any order, but just they're in this order for our purpose of clarification. We look at uncertainties all by themselves. And we look at uncertainties and use the symbology of a circle to show this is a random outcome. We don't quite know where this will break, but this is our current understanding of how it might break. And so again, that uncertainty comes first. Next is a negotiation or a conditional probability. And we display the symbology of a square to identify whether we've got a regulator acceptance with us of generic cleanup goals or risk-based cleanup goals. And from there, we move into the decision, which we identify with a diamond. And a decision, again, is held apart from a negotiation, held apart from an uncertainty, the different silos of events that we're looking at. But it's displaying the very same data that we saw in the previous slide, just adding the symbology and adding clarity around whether we're looking at an uncertainty or a negotiation or a decision. From there, we can add additional complexity like, will the remedy actually work, or will we need to back up down one node of this event tree, back up and go down another node at a correspondingly incremental cost. That's the way that we look at decision trees or event trees today. But the point that I want to clarify for you is at the bottom of the slide, it's important, as always, keep your decisions very, very far apart from your uncertainties, label them differently, calculate them differently, put them in a different order. Put your decisions up front or put your decisions at the end, but don't conflate them or mix them up with your uncertainties. And again, also keep both of those far apart from your negotiations. Another tool that we've found common use to have lots of value for looking at environmental liabilities is to find a preferred strategy, define that one very clearly, and then perform a SWOT analysis on it. We find that articulating shared understandings helps make a thinking process visible. Those two things, shared understandings, visible thinking process, are absolutely essential for doing good decision analysis. There aren't two ways to do it. It's not a best practice or a lessons learned. You have to do things this way because, again, good decision analysis means that you can revisit your decision in the future and look back on it and identify if there were root causes of failure that will help you do the work better on this one site or another similar liability in the future. So the 4 quadrants, and I'm just using Microsoft PowerPoint here to display these 4 quadrants with associated labels. And we found through time, time and time again, these are generally what strengths and weaknesses and opportunities and threats look like. I won't read through them here for you today. Feel free to pause the screen if you're watching a recording of this. But if you're interested in these generically work for lots and lots of sites. You'll find that probably half of these reasons will apply to most any site that's out there. Because environmental liabilities tend to resemble one another quite a bit more than they contrast with one another. Sure, each site has its own depth to groundwater, matrix of contaminants, its own pathway to offsite receptors, including wetlands and sediments. However, we find time and again that the solutions, the preferred alternatives, the solutions to the problems generally start to look alike after you do 5 or 10 exercises like this. And ERCI has participated in over 200 detailed looks over the last 22 years. So that's not just anecdotal information, but that's been our experience in facilitating this type of work as well. The key takeaways that I want to share with you on this slide are really the takeaways that a user would take away in evaluating the strengths and weaknesses and the opportunities and threats. So again, there are site-specific analyses points that draw a user's attention back to an individual quadrant so that they're able to take away, again, more detail than might be intuitively obvious. Because what you're trying to do in this sort of display as well is to show why this preferred strategy makes sense but can also fall apart. You're trying to show why this is not your backup plan, but this is your primary plan, but also explain reasons why a backup plan may overtake you, may force itself on an individual site strategy to resolve the liability. To get to that point of having a preferred strategy, you need to go through an exercise like the following of a strategy table. And to get that, you need to identify what key issues are of concern on an individual site. So in doing this strategic analysis or decision analysis on an individual site, we find that as quick as it is to use this sort of table and display the information, it takes a lot of thinking to get to this and often several iterations to get it to a professional standard of care. But the basic idea is that in each of the columns here moving left to right, and I've got 6 displayed here, is you've got a regulatory framework to work on and worry about. You've got some disposal options to work on and worry about. A degree of source removal, whether or not there will be a regulatory reopener that will cause you to revisit your strategy in the future, what your end state vision is for the property itself, and what you can look forward to for recoveries of costs concurrently. Every one of those variables can be different for another site, and I've seen as many as 12 different columns for an individual site, and I've seen as few as 3 or 4. But often there are several degrees of freedom for several individual issues. And again, if you go down to looking at 4 different issues, part of your purpose in generating a slide like this is making sure that there is a divergence, there's a robustness to the different alternatives available. You're not trying to show that we can start doing, we have issue number 1, and we can take approach A and we can start that on Monday, or we can start that on Wednesday, or we can start that on Friday. Those are not 3 different robust, creative, doable alternatives. Those are just 3 different versions of the very same thing, varied slightly by timing. The idea in generating each of these individual rows is that you're saying, not that we would do this, but this can happen, or we can decide on that, or we can go with this method, or we can try and go off on a limb and try that approach. Strategy table is meant to articulate that range of alternatives. And the reason I lay this out here is because you want to have this full spectrum of options, even though you may find some of these absolutely in conflict with your organization's values, absolutely in conflict with what a regulator or the public wants. You still want to show them because they're ways of extinguishing a liability that are out there. And by picking a different thread through these, you're expressing what your organization's values are, and you're identifying which permutations of those different combinations of alternatives actually constitute a viable strategy for you. But you don't want to short list what will actually be acceptable to a given audience. You want to be thinking big when you generate a strategy table, even though you may say that there's absolutely no way we achieve or be happy with some of these outcomes. So for example, if you're identifying an aggressive remediation strategy, which I've labeled here with a blue arrow, you'd connect the variable of saying we're going to go after a current consent order and not wait for a new consent decree or let a state agency perform an enforcement action on us, or instead go with the current consent order. That's our basis for performing some cleanup work. The next item over, we're going to use trucks and move the dirt on site. And that's how we're going to handle our disposal of soil. We're not going to truck and rail the dirt away. We're not going to slurry the soils up into a mud and put it onto a barge. Instead, we're going to leave that soil on site and move it around with trucks. From there, the next item in the blue arrow strategy, the aggressive remediation strategy, is to do a complete source removal and to be wary of a regulatory opening from the county for the groundwater issue. From there, our end state vision is we want to have the site completely clean for available for unrestricted reuse and sell the property when the work is done. And we expect to cash out anyone who owes us money for the site, to cash them out and not have them fund the work in real time and have that generate some concurrent issues with pace to closure. That thread, left to right across this strategy table, constitutes one permutation, one combination of each of the variables from each of the columns, that moves us from left to right and identifies one way that we have a strategy for this individual site. Not the only one, of course. There are many, many, many permutations available to us on this, but what we're trying to do is say, here's the full spectrum of opportunities that we can pursue, the full spectrum of strategies. Here are the ones that we focused in on, and by elimination, here are the other issues, the other alternatives that we did not pursue with any further evaluation. Another tool, aside from the strategy table, is the decision hierarchy, identifying those variables or issues that are worthy of focus, which would be worthy of putting onto a strategy table that we saw on the previous slide. We would use this slide to very simply identify things that we think are givens, that we are not going to try and contest or evaluate or use as variables. And at the bottom of the screen, the details, what we think are site-specific tactical implementations that are not relevant to this phase of our decision-making process or our capital allocation process. So things like corporate policies would be way out of scope and be givens. Details like project controls and vendor selection also be way out of scope because, again, they're at too low of a level of detail. From there, we find that to go with the pyramid of the decision hierarchy, we can use a framing expression of where the liability is and isn't, what's in and out of scope for the problem as well as prospectively for a solution. So again, it's both a definition of the problem and solution, and it's laid out by how we draw these borders and put labels of issues inside of or outside of those individual boundaries. So again, in scope for liability includes the 5 items that you see there: the extent of the groundwater plume, what remedy we're going to pick for the soil and for the groundwater, how we're going to reuse the property, what done looks like for that, as well as whether we're going to acquire neighboring properties. We're saying for this liability, that's in scope. What we're saying is out of scope, either because it's at too low of a level of detail or that it's at too high of a level and it's something we should take as a given, are things like, will the regulations change in time for us to change our strategy? We're going to call that out of scope in this example here. Whether or not we have insurance coverage and whether or not there's an asset retirement involved. We're saying those issues, and there may be dozens and dozens of others, we're calling those out of scope for either the problem definition, the solution definition, or a little bit of both. Again, we find this tool is useful as a communication exercise. It takes thinking. There's not one size fits all. This is just an expression of what the tool looks like. The tool is the easy part. Like all of these things, we can do Monte Carlo modeling in minutes. The tools have never been easier to use. The clear, crisp thinking, the right words, the articulated expression of a consensus, that's the tough part. That's the labor-intensive activity that we found is necessary time and again on looking at environmental remediation liabilities. Another tool that we find is incredibly useful to differentiating between what the problem is and what a solution might work out to be is an influence diagram. And this is an influence diagram that we would use, for example, to pick out the outcome at the very far right end, the liability value. So if we're trying to figure out the liability value, we're now trying to back into the things that go into what the liability value is. And that moves us from the right side back up to the left where we start. And so when we're trying to figure out, for example, an intermediate stop point of what is the soil remedy going to cost, our influence diagram tells us, and we agree that these are things we're going to pursue, is we need to understand things like what are our unit costs going to be? What's the range of outcomes on our volume? What's the bulking factor for when we excavate soil and it sort of starts to breathe? What does it expand out into? And those can trigger dramatic changes between what the soil was supposed to look like in the ground and what it ultimately turned out to be when we started trucking it around. What's the overburdening slope factor? We can't excavate every plume at a 90-degree perfect vertical angle every time. Sometimes we have to excavate them at a 25 or 45-degree angle for safety. Therefore, that means we're going to be excavating some clean dirt in the midst of excavating some contaminated dirt. Therefore, all of that folds into our soil remedy cost. And this is not a comprehensive list. This is just a starting point to say if we're going to understand our soil remedy cost, which is a part of understanding our liability value, we have to understand these factors among others. Building this influence diagram, the thinking that goes into it is the tough part. Displaying it, never been easier. The tools are the easy part. From there, we can get caught up into some logic traps or some cognitive dissonance if we don't look at where this information gets used and how it applies to our work. So again, why I laid this out this way is to say, even though we understand our soil remedy cost, that doesn't mean we have a liability value calculated yet. In other words, if we're at an intermediate point of saying we know that soil remedy cost box really well, now we want to figure out what the liability value box means. We have to fold in other factors. And those include things like the following. If the soil remedy fails, what's our backup plan? And what is that backup plan going to cost, and what influences that? That folds into our liability value, as does the credit rating of any counterparties that are sharing in the expenses with us, and whether or not they pay on a timely basis and have the capital to do so. All of that as well folds into our liability value. So again, it's tempting to step back and look at an environmental liability as just the cost of a solution. It's tempting. It's easy. It's fun to look at the different technologies and say, do we pick that technology or that or that? It's fun and interesting. But the heavy lifting in calculating a liability value means you don't stop there. You look at more variables aside from the remedy selection and aside from what goes into that soil remedy cost, and you start looking at it from a business perspective of what will an owner want to know. Will the remedy work? How reliable is that cost estimate? How reliable is the reimbursement estimate? How does that all fold into how we ought to be valuing this environmental liability? So again, a useful communications tool, but again, only as good as the thinking and experience drawing into it. One of the tools that's out there is an EPA Army Corps of Engineers guide to developing and documenting cost estimates during the feasibility study. Great document, came out in 2000. One of the things that it tells us to say is when you're at an early stage of just finding out you have a liability, or you're just getting ready to go collect some soil and groundwater samples to understand just what's out there, you can expect a wide range of outcomes, a wide range of cost outcomes, not just for studying the site, but also figuring out a good remedy, implementing that remedy, and then carrying out the operations and maintenance phase at the very end. And this diagram is part of that document from EPA, and it's a funnel on its side and just shows the gradual narrowing or tapering off of uncertainty as a project or a solution moves from early stage to late stage. When I look at environmental liabilities, I don't look at them exactly the same way because I still see that there's a lot of unknowns until you're actually close to done, that there's a lot of shadow probabilities, shadow issues that are still lurking out there, and they're just normal, ordinary uncertainties. And that's just a part of the difference in the scope of this document. This document is incredibly useful for preparing a feasibility study for a Superfund site. But if you don't have a feasibility study stage and you don't have a Superfund site, you got to just keep in mind that it's got some limitations and that it's got some instructions that may not be comprehensive enough for you to finish the work with just what's listed in this document. But again, it's a great starting point. So keep in mind that when you need to know and understand your cost ranges, you have to work your way through some data sources. We're in a great time today. We're in an amazing time today where you can go to websites on your phone and you can find comparable cost experiences that other enterprises have had in resolving their environmental liabilities at similar problems. In other words, there's a sort of a Zillow out there for environmental liabilities if you look in some specific places. The ones that we find are best are the 5 that are listed in the lower left corner of this slide. The Federal Remediation Technologies Roundtable, where public agencies on the federal level are publishing their cost experiences with handling individual sites. EPA's Record of Decision Database, which publishes the financial forecasts prepared in compliance with the guide in the upper left corner here. So it's a series of cost forecasts of what different solutions might cost. Again, it's not experience of spending money in the field, like item number 1 is, but it's a basis for knowing and understanding and estimating what a comparable site might be costed out, and what that cost forecast can look like. I think one of the best sources that are out there are vendors actually doing the work. They've each taken different steps to adopt cost accounting systems and proposal validation systems, as well as keeping track of what they spend in the field and why change orders occur. So again, vendors are probably the best to ask about what can go wrong, what constitutes the uncertainty, and coming up with a liability forecast. And relying on their cost engineering expertise is probably a very effective investment in validating what the numbers can look like. Other sources of cost data include industry benchmarking of what your peers are spending on comparable sites and your own cost accounting system, what you have been spending on your own sites in the last 5 to 15 years. Major cost accounting systems have come up, proliferated really since mid-95 or so. So the common systems are SAP, Oracle Financials. A predecessor system name is PeopleSoft, which is now part of Oracle. J.D. Edwards as well. So again, if you're using any of those enterprise-wide cost accounting systems, you probably know every penny that's been spent in the last 10 to 25 years at individual cleanup sites. Harvesting that data is part of good analytics. Another tool that we find is useful is characterizing the strategic alternatives that you got for an individual site, but just using this narrative to compare them one to another and just show what is in common with each of the strategies that you've identified and what are variables, what you're choosing to do differently from one strategy to another. Not a financial analysis, because that's coming up next, but this is the analysis that frames how you're going to do your costing, because you're identifying if you figured out the cost in one silo, one column here, that you can apply that very same set of cost metrics to your other strategies and save time and effort and turn the estimates around faster. Where all this is heading is you're trying to come up with liability forecasts that are useful for your reserves, but also budget forecasts that are useful for your cash flow planning. So this is where the conflation of what the solution is and what the problem is, this is where it starts to get complicated. And our company, through trial and error, has been working this for 22 years. We found that this sort of display really does work, really does help clarify the daylight between what the problem is and what the solution is. Off on the right side is the reserve case, and that's an expression of what the problem is, of what sort of resources are going to be needed to fix the issue. Cases 1, 2, and 3 are different looks at the solutions, different ways that you can resolve the environmental liability that you've identified over in case R. Sometimes they match, sometimes there's a little bit of daylight between the two, but as you move from an early stage project to a completed project, those gaps will narrow like we saw in the funnel diagram. So if we are in the middle of the process of picking a better alternative, we may find that there are some forecasts, some strategies that make the liability worse or spend more than the problem is. And that's, again, something to be incredibly focused in on and be highly aware of, because it's a tough set of questions to justify spending more on the solution than the problem would seem to cost. Explaining that capital allocation is a part of everyone's work, and if you're watching this webinar, doing it well is, again, one way to help your organization through in the future. Another tool that we find works pretty well is to step back to generate the display we just saw, display that data using metrics prepared in concordance with fair value measurement. What does that mean? Well, if you draw your attention to the center two columns, you'll see level 1, level 2, level 3 inputs, site-specific conditions, KPIs, which is MBA speak for key performance indicators, and unit costs. So this column is meant to say in order to prepare our estimate, we looked at these baseline conditions at what we would try to satisfy. For example, for a life cycle cost projection, you could say our level 1 or 2 inputs were things like, we plan to do 12 years of pump and treat for groundwater, 10 gallons per minute from 5 wells. We intend to pump out the entire aquifer 3 times across a 19-acre space. So 3 pore volumes, 19 acres. That's something, as a person, again, with 2 business degrees, have pity on me. But a person with 2 business degrees, I can understand that's the problem and that's the solution all in one statement, that we're going to be pumping this groundwater out for 12 straight years at a known rate, and that means all the water is going to turn over 3 times, and that should give us a solution that should extinguish the problem. However, you look at the very next row and say, in case that doesn't take care of the problem, here's a supplemental solution that can take care of the problem a few times over. And it just, as I've got expressed here, a 25% cost increase for the 4th pore volume. We add additional wells to get us up to 10 in years 8 through 12. So again, this means that we're going to evaluate things in years 6 and 7 of our program, as expressed in that first row. We're going to go years 1 through 6, and then in year 7, we're going to decide if we need to double up on how fast we're pumping out the groundwater. And if we do, that's going to mean our costs bump up by 25%, and therefore we're going to have some incremental costs to help resolve our liability. That's, again, a look at our solution. Doesn't mean that we're done. Next row after, additional 10 years of pump and treat for the 5th and 6th pore volume. That means that we've had a strategy not work out, and we've got to keep hitting it with a giant bag of money. And that means the financial impact is a knowable thing, but again, it shows the gap closing between how we identified the first solution, which is row A, with the consequential impacts that get us to the definition of the problem, which is the sum of all of these line items. The next couple of line items have to do with things like project management, regulatory oversight, counterparty risk, income and offsets from renting out the site as a brownfield, getting insurance recoveries from others. All of those cash flows, in and out, constitute the entire picture of what the problem is. And as you can see from the summary of the numbers at the very bottom, a fair value measurement can tell you a significantly different story of what it costs to implement a solution, which would just be row A. And again, what the shareholders, what your organization's stakeholders are going to experience is at the bottom of the slide. That's the liability valuation. Money going out, money coming back in. Maybe it's positive, maybe it's negative. But what your organization might get trapped into thinking is it's what we buy. It's the external vendor quotes that we get service proposals for. That's our liability. That's tempting, but it's one of the things we cover here in today's webinar. It's a trap for us. Our liabilities are not the solutions. Our liabilities are not valued at just the value of our current solution. They've got much more detail behind it. Again, keep in mind the best practices for DA work. Make sure you're splitting your decisions from the random stuff that's going to happen to you, the uncertainties. You weight your decisions with your opinions. Express your opinions, label them, identify that they're based on assumptions X and Y and Z. You'll want to remember what those assumptions were, so document them and label them. That's just good best practice. Weight your uncertainties with data. Go fishing for comparable sites, comparable situations and issues, and use data to back up the range of uncertainties that might be happening to you. So again, backup is important for each one of those decisions and uncertainties. Make sure you're using tools that are fit for purpose and that you're only looking on your future decisions, that you're not doing at the same time and look back on how previous decisions didn't work out as originally intended. What you're also trying to do is you're trying to confirm something called the expected value of perfect information. In other words, you're trying to figure out what it's worth for you to know how things will play out and whether you've got to value your liability at a higher or lower number, or use one strategy, one solution versus another. Ideally, you're using decision analysis where the difference between those is more than $1 million. If it's less than $1 million, you can scale your tools down, use a simpler approach, because again, apparently there's less financially at risk. I recommend as a rule of thumb starting with the most expensive, the highest spend sites, and seeing where the trade-offs seem to occur in a portfolio. Generally, it seems to be about 30% deep into the site count where the trade-offs for doing good decision analysis really stop paying off. But it's also, again, early stage sites, high dollar sites, that's generally just a rule of thumb. You're always going to have those new emergent projects or the new strategic transactions which draw attention over to different ways to looking at liabilities. Finally, it's important to get to model your uncertainties. We'll go into the next few slides here about how to do that modeling because, again, it's a responsible and accurate way of characterizing what the financial risk to an enterprise looks like. And those are things like, will a regulator like my remedy? That's one blind spot that we find time and again in doing our work is left out of doing a good decision analysis. Will the remedy fail? Again, this is a common thread that we find, but it also can be a little bit embarrassing for a project manager working with their external consultants who've got strong faith in the doability of a remedy to talk about what if it doesn't work for reasons outside of control, outside of good engineering, outside of good science. It can be tough for any person looking at their project to say, what if things don't work out the way I want them to? What is my backup plan going to look like? Other external factors like will counterparties fail? These are more knowable, more transparent, and actually easier to calculate than ever before. And then endpoint change. Will there be changes from the regulator or public's perspective about what they think constitutes a good remedy? Finally, it's important to remember to document your decisions and move on. You'll want to move on to another site because it's not worth half a labor year to spend time on it and keep revisiting it. But you'll have to move sort of like a honeybee or a butterfly. You'll have to move from site to site to site to site to site. Therefore, documenting your decisions well and moving on is an important part of using economies of scope, economies of scale, of doing many things well. Documentation is pivotal to making sure that you're able to understand your decisions today, but also look back on them and improve them tomorrow. The lessons learned that ERCI has got to share with you today are, again, keep in mind that project costs, the budgets, are not the liabilities. DA needs to be applied sparingly. Decision analysis is a great tool, but it isn't great for every situation. High uncertainty correlates with early stages, but not absolutely with total project spend. Don't assume that everyone is familiar with these tools or knows how to use them well or knows how to use the results well. They're fairly intuitive, and they can be, people can pick up on the learning curve pretty quickly. I'm just generalizing here. But again, don't assume that everyone knows how to run this or how to frame out a liability or how to construct a strategy table the first time out. This can be a new experience for anybody, even though they may have decades of experience in an industry. But finally, don't limit your process to just remedy selection. When you frame a liability, construct an influence diagram, remember that the liability, the problem, is not the solution exclusively. And then watch out for learn, forget, learn, forget, learn, forget. That's a metronome, Darwinian metronome that's out there waiting for all of us. We're all going to forget everything eventually, especially if we don't have things documented. Organizations in general, very good at forgetting things. So documenting a shared understanding, documenting a strategy, you will find that's useful time and time again as teams turn over, consultants come and go, employees come and go, budget priorities come and go. It can be important, again, to rely on documentation because, again, it provides that enduring source of reference for why good capital stewardship decisions were made. As we shift gears a little and talk about probabilistic modeling, I want to make sure that everyone's clear that these are two very, very different things. Probabilistic modeling is useful for looking at costs, useful for looking at timing. You want to be using -30 plus 50% accuracy in your cost forecasts. If you've got a cost in the next few years, if you've got something that's 5 years or more out, you want to use -50 plus 100 for your uncertainty range. And again, you want to make sure you're doing a critical statistical step called correlation. I'll show how to do that in a moment. If you're doing DA, again, remember the reminders from the previous slide. Keep your uncertainties separate from your decisions. Decisions are things like, how fast are we going to clean up this site? What cleanup goals are we going to pursue? What remedy do we want to implement? What are we going to use the property for when we're done? The uncertainties are things like, what will diesel cost? What will electricity cost? What will our vendors' labor cost? Will our counterparties be around? They're very, very different factors, but they're things that are going to happen to you as opposed to decisions that you could make in control. Make sure, again, you've got a great set of workable alternatives, that you're evaluating both mature and emerging technologies, looking at local versus nationwide contractors, and again, be very clear about timing. It's absolutely important to make sure that everyone's clear that the exciting cleanups where things had to be done on an urgent, emergency, expedited basis, hopefully most of those cleanups are done and gone, but there's a matter today of prioritization of if you have finite resources, which cleanups do you want to pursue first, which liabilities do you want to extinguish first versus those that can wait. We find the best practices for doing this type of Monte Carlo modeling involves using an assumption table, which means you've got to step out on a limb and say, these are the uncertainties that are going to happen to me. Not my decisions, but these are the uncertainties that are going to happen to me. And here's the P10, P50, P90. If you look really closely at the middle 3 columns in this table here, you'll see P50, P10, P50, P90. That means within a spectrum of 0 to 100%, you're making an assumption about P10, this is going to be an optimistic outcome. It'll happen 10% of the time, it'll be that number or better for us. P50, that's a median value. Half the time we'll expect a number above that, half the time we'll expect a number below that. P90 means that's pretty much 9 times out of 10, this is as bad as it's going to get. It's a pessimistic outcome, but not an absolute maximum. Those 3 assumptions, that takes discussion. That takes review, that takes peer information, that takes research. In other words, this takes time and cost engineering. The next couple of steps of calculating the expected value takes the time that it takes me to finish the sentence. You can do an expected value calculation in moments for what may take you a day, a week, or a month to construct as a set of assumptions. But again, time and again, when you do the P10, P50, P90, have that peer reviewed, get everybody to say those are the right ranges of outcomes. Doing the last part, that green column that's labeled expected value, doing that takes 5 minutes. It's the easy part. But again, you're condemned to doing it again and again and again if you don't do this first part right of identifying your variables, identifying your uncertainties, and then displaying the bracketing to make your thinking process visible. You skip those 2 steps, doesn't matter how fast you do the Monte Carlo model. Doesn't matter how fast your computer is. What matters is you've set yourself up or you've avoided the need to redo this step of framing the problems, identifying the uncertainties, and bracketing those uncertainties. With that in mind, I just want to show you how fast it is to do that. For that, I'm going to step out of the PowerPoint for a moment, switch over to Microsoft Excel, and we'll wait for the screens to catch up for a second. What I've done here is switch over to Microsoft Excel and identified that I've got a couple of different variables in my cost forecast, and I'm calling those variables study, design, remediation, and then operations, maintenance, and management. Saying that these are the 5 components of cost that go into my grand total, and here I've got a grand total cost of $5.2 million. Now, one thing I mentioned in the previous few slides is it's important to correlate your assumptions. So what I wanted to do is just give you a sense of, for example, here is our remediation cost, and I'll let Crystal Ball, which is the Monte Carlo tool that we use. At Risk is, by the way, from Palisade Software, another phenomenally great Monte Carlo modeling tool. But we're using Oracle's Crystal Ball in this example here. They both work exactly the same way as an Excel add-in. But the way we're using it here is we're using a beta distribution and saying that this type of distribution, and again, we've got several to choose from. We chose beta because that's, generally speaking, how money behaves. Log normal, Weibull, beta pert, those are other examples of the ways that money behave. They behave as these sorts of distribution types. Money does not behave as a normal distribution as much as you might want it to, or as a triangular or uniform distribution. Money doesn't act that way, but that may be the basis of some assumptions that you have. Just keep in mind what your results will look like is they'll probably wind up looking like a beta or a Weibull curve, and each one of these curves, again, has different science behind it about how they're calculated. Keep in mind also you can have exponential or geometric curves that come into play because you may be able to, for example, see a groundwater pumpetry system work great and then be a candidate for turning off in year 18 or 19 or 20 or 21, and they follow a decay function that's expressed as, for example, an exponential or a geometric function instead of the others. You're also in these tools able to put in binary, trinary outcomes via the yes, no, and the custom distribution. But again, we will skip those for detail for today. And just again, focus in on our beta distribution for this cost variable. And so here we're saying, for example, in the lower left corner, our absolute minimum is 0, and our P10 value is $1.5 million. Our P90 value is $6 million, so quite a bit higher. And then our absolute maximum is $10 million. So far, so good. That's an incredibly wide range of outcomes, by the way. But again, if you're looking at a very, very early stage cleanup, having a wide range of outcomes like this, not all that unusual. The next couple of steps, in turn, involve us putting in assumptions for the different, the other different variables that are out there. Here we have operations and maintenance, bracketed from a P10 value of $500,000 and a P90 value of $2 million, and then working chronologically backwards into the study and design phases. Again, we use different assumptions. Here in the case of the study cost, $50K to $200K. Again, putting this information in and generating the distributions are the easy part, and editing and modifying the displays, very simple. This is giving us an expected value for this range of $114,902. The precision is artificial, but generating this expectation of precision is one of the mysteries of using Monte Carlo tools, right? Is these assumptions, I'm sorry, this forecast of $114,902 and change, this is coming from inputs that you put in, and again, these very, very high-level assumptions of 50K on the low end, 200K on the high end. The next step after this is once you've got your assumptions put in, you've got to go through a critical step here of correlation. So I'll step aside and say this is one of the more common user errors for using Monte Carlo tools is to skip this step here. But if you don't do this, the other variables that you put up in your Monte Carlo modeling will behave independently and random against one another. In other words, if statistically you run a model and say, okay, everything is behaving independently, every variable is uncorrelated, they're going to cancel each other out. So the expected value will be fine, but the range will be artificially truncated or narrowed versus what it would ordinarily be or properly be determined as. So I include this correlation because it's, again, an easy one to skip. It's tempting to skip it because it involves, again, an awareness or understanding about variables that might not be particularly visible. But what I want to do in sharing this with you is to show you just what the tools can do very, very quickly, and that you need to have some thinking process behind, because the value is in the thinking. It's not in running the math and having the model do its work. So again, in this example, what this tool requires you to do is to say, okay, we're at the OM&M stage and the design stage. What are the intersections of those two events, those two cost variables, and what does the cost variability of one have to do with the other? And one thing I assert to you that's important to remember for environmental liabilities and doing financial modeling is they're all highly correlated with each other. They're highly positively correlated. There are very few exceptions where spending in one area can cancel out spending in another area. Grant you that. But generally speaking, if the study goes off scope, the remedy is going to go off scope. The remedy goes off scope, the OM&M is going to go off scope. So again, they all move up and down, generally speaking. They all move up and down together. So they have high positive correlations. If you say, for example, and I'll use this tool for demonstration, if you say things are going to cancel each other out, you have these two variables where we've got the design cost on the vertical axis, the OM&M on the horizontal axis. Don't worry about the numbers, but just look at the dot pattern. You can say the costs sort of, they sort of randomly behave with one another, like they don't have anything to do with each other. If you increase the positive correlation, just notice how the dots sort of gradually gel along the line and just sort of gradually shift as I move the slider left to right. Then we're showing a more and more positive, stronger correlation between what you spend on your design costs for your remedy and what you'll be spending on the OM&M for that very same remedy. Here I've got at the very end the very perfect correlation to say every time you go up 1 percentile on the design, you go up a percentile on OM&M. That's not necessarily true. But you'll find that generally speaking, a strong positive correlation like 0.8 or 0.9, this is what normally people would experience in the field when you go up on one, 8 times out of 10, 9 times out of 10, you go up on the other one. And you repeat that process for each of these other intersections and say, for example, when we go up on the remediation cost, we expect to go up on the OM&M cost. In other words, if we spend more on the remedy, we'll be spending more on operations and maintenance of that remedy further and further off in the future. And again, high positive correlation looks like this. No correlation of any kind looks like that. Again, if you let the model do itself, by default, correlations are off. There's no correlations of any kind. But if you do amp them up to this degree and then let the model do that work, that in turn will let you be able to see the modeling results display something that's far more intuitive and far more realistic of what happens. Once you tell the model to do its work, we're working with great computers these days. This sort of modeling that we're seeing here today, 20 years ago, used to take 5 to 15 minutes. Now we're able to do multiple iterations within the course of a minute or two. But the overlay that I want to share with you is basically the idea that if we didn't correlate our assumptions, we'd have something like the blue line, where we'd see sort of this narrow range. Let me display it a little bit differently as a frequency chart. And I know it's a little busy here, but if you look at the narrowing of the tail for the blue line, artificial confidence about how narrow the range is. The range is 1 to 11 million instead of 0 to 12 million, the way it is. And that's, again, part of what correlations do, is they artificially, if you leave the step out of doing correlations, you can artificially narrow your, just by leaving variables out. Now here I've just got 5 variables. Imagine you've got an issue with, a site that you're trying to model that's got 10 variables or more. That process of doing the correlations well can be quite a bit different, and you can find that, again, with more variables, you're finding the need for correlation goes up astronomically. So again, it's just as I fast forward here through the content we've been through so far, I just want to again point out the value in doing this well is not just in having the tool, but it's also having the discipline to do the work in a way that can be reproduced later on. The best practice that we see, just to return to PowerPoint here, the second best practice that we see is to use a standard work breakdown structure as a sort of a checklist or a validation to make sure we're asking the right questions and not leaving out any major variables of our cost forecast. From there, of course, it's using the proper distribution type. Different distributions work for different variables, and I've got some examples here in a moment. And then finally, focusing on how reliable your estimate is. Don't be afraid to go back to your strategy table, back to your influence diagram, and back to your financial model a few times and make sure that you're characterizing your decisions as your decisions and your uncertainties as your uncertainties. You won't be the first or the last person to misinterpret initially whether a decision is an uncertainty or vice versa. So again, reiterating the process is ordinary, but again, I think with more experience, this is a learned and an acquired skill. Excellence is definitely doable. Again, it's important to systematically work through an entire work breakdown structure, to be very realistic about timing and developing a concurrent cost-loaded schedule, and that in turn means generating ranges for achievable outcomes, not just about the cost, but also about the implementation schedule. And one of the great things that Crystal Ball and Excel and Microsoft Project can do is it can let you model time as well as the financial exposures and risks that you experience. The next few slides I'm going to fast forward. Feel free to pause this if you're viewing this on YouTube and just review each one of these assumptions in a little more detail. But I just go over in turn case studies here about how to model individual variables for environmental liabilities using the different distribution types that are available to you in Palisade's at-risk and Oracle's Crystal Ball. They both function in the same way. And again, you pick a distribution, you identify your low, mid, high values, you validate that the range that you're looking at is, makes intuitive sense to the issue you're looking at. And if you again have any questions, you revisit and recalculate that individual line item. Why do we want to do correlation? Again, I just want to make sure that we're all clear on the points that uncorrelated assumptions behave randomly. They tend to cancel each other out. Assumptions for environmental liabilities are, in fact, highly correlated. One does impact another. And the degree and direction of correlation, there's something to discuss. There's something to discover from similar sites. But basically, clarity on that means you're going to have a more accurate, more defensible model. The correlation process is something I describe here using older versions of the Crystal Ball software. The screen captures are again meant to convey how to do the work, but basically you're adjusting for a positive or negative correlation. Again, generally positive, generally 0.8 to 0.95 is normal for environmental liabilities in my experience. If you're working outside of Microsoft Excel and instead working in Microsoft Project, good news is you can also apply Microsoft Project, or if you work with at-risk, you can apply that to Primavera, I believe. At any rate, you can apply uncertainty and ranging to individual timing or cost constraints and see what that in turn has an impact on in terms of cost and schedule implementation. Again, keep in mind these are just quick views for prototype displays for your benefit, so I don't have any live iterations that I want to share with you today. At the end of the day, we're after a reliable forecast. This is what done should look like if there's good thinking behind this. And again, if you look at the percentiles in the lower right corner, a user is able to pull out the absolute min, the P0, the absolute max, the P100, and see a whole range of values inside to help interpret what an individual line item or a total remediation project is expected to cost. From there, a user is able to determine how that information is supposed to get used. One of the more common uses is to figure out where to spend time. I advocate to you that decision analysis helps you understand if you should spend time on the high cost items versus the high uncertainty items. Sometimes they're the same things, but sometimes that's a matter of definition, and you have to look at what items are going to display lots of uncertainty. So if you know this blue bar, for example, of where your site's, your project's entire basket of uncertainty is going to come from, and then bust it apart and say it's going to consist of these 4 or 5 line items, that's where all of our risk is going to come from. This analysis can help you figure out if you want to do different things in contracting, assessment, design, other project controls to make sure that these uncertainties don't kill your project, don't kill your solution. So again, these are parts of issues with defining the liability and also defining an implementable solution. Understanding these may tell you to spend more time on the higher uncertainty items, less time on the low uncertainty items, because financially you can't really have a major impact on those. From there, you can convey that information into what I call a decision sequence diagram to show when your decisions will come up, what those degrees of control will mean in terms of financial outcomes, and in turn, what that will mean in terms of cash flow for the whole project. Probabilistic forecasts, like we saw before, can also be used to show the daylight between what belongs in the reserve today, what your understanding of the liability is today, and what the watch list consists of. And that could be, for example, the gap between an expected value, which you may reserve, and the P90 or P100, which you would probably not reserve under any circumstances. But knowing what's in that daylight, which can be the factors that we displayed 2 slides ago in here, identifying what belongs in your watch list, we found time and again is a useful display of information. Other things you can do with these tools, you can compare different scenarios and say the reason that I like or don't like scenario 1 or 2 or 3 is its financial behavior relative to the other scenarios we have available to us. Generally speaking here, if we're trying to optimize strategy selection, toward the right is bad, toward the left is good, a more vertical line is good, a more fallen over slope, a more horizontal slope is bad. Therefore, we would prefer 2 over 1, and we prefer 1 over 3, just based on this sort of analysis that we've got displayed here. Other things we can do with the Monte Carlo modeling are projections, time-based projections of looking forward, for example, with our counterparty risk. Where do we think different counterparties will be 5, 15, 20 years from now? Do we want to cash them out today because they may be weakening over that 5, 10, 15-year time span, and we don't want to risk losing their ability to pay on an individual liability? This type of counterparty risk covers things from asset retirement obligations to remediation liabilities to, strictly speaking, just insurance claims. It covers a whole variety, but again, I want to point out to you that knowing today's credit ratings, which are freely available for every enterprise, predicting where they'll be in the future, it's a Monte Carlo modeling task. That's actually a separate webinar that I've got displayed on our YouTube page if you're interested in more detail. What you generate from there is a display that looks like this that shows you not only the value in the lower left of your own default, but also the probability and cost of everyone else defaulting on you and increasing your enterprise's own liability. Other places to use this information are in generating a watch list for an entire portfolio or an individual site. So in this example here, we've got an individual site's watch list, and notice way off on the far right, we're saying we've got a range of dates and a range of costs for these unknown issues that are still coming to affect our definition of what the problem, what the liability is on a given site. Monte Carlo modeling helps you understand and calculate what those range of dates and what those range of costs will look like. When you roll up that information from individual sites, you come with a portfolio-wide analysis like this, where you're saying when a given trigger event happens with an individual site, that's in our second column here, when we reach that, I'm using accounting terminology here, when we reach that obligating event or that new recognition benchmark, then we've got a reason for revisiting our reserve and our whole liability cost forecast. And we have a probability of that even happening that's understood and documented and listed. And in turn, we've got a Monte Carlo range of low, expected value, and high, along with a range of timing. And all of this information together helps populate a reserve increase, a reserve forecast. of future increases. And that in turn, whether it's for an individual site, for a whole portfolio, can look something like this, where you're displaying not only what reserves you've taken so far, but also how in the background your watch list is gradually going away for an individual site as you're taking more and more and more increases. And so again, helping anyone who's involved in good capital stewardship with you, they'll want to know where the spending's going, what it's achieving, and just tracking actual spending isn't enough. Tracking where the reserves have come in and the watch list has gone down is another one of those metrics that helps describe where the money is going and how that new understanding, that incremental knowledge adds value to your enterprise. I mentioned before a probabilistic reserve increase forecast. This is what one looks like for an individual site, where you're saying, I know what I've added so far in the past, what am I going to add in the future? Well, if you have your watch list in place, you're able to generate this sort of information about the range and timing and the range of reserve increases. You're able to project that in a way that's absolutely transparent and clear to anyone interested in following up. With that, we are at the end of our webinar today. I do want to thank you for learning about this topic with us. We've done Monte Carlo modeling of environmental liabilities for 22 years and are very passionate about the work. We hope you found this content useful. If you'd like more information about us or would like to reach out to us, here's some information about our company at ERCI.com, along with my contact information. If you're interested in our other webinar topics, you've probably already found the YouTube page, but I encourage you to keep in touch with us and to look at this YouTube page to see other recordings that we're uploading on similar topics relating to environmental liability management.